This is part two of a two-part video on the financial system. If you're just clicking into this, please go back to part one, or this is going to make a lot of sense. All right, see you there. Thanks. Bye. What a fractional reserve system refers to is that banks are required in the United States to keep a fraction of all demand deposits on reserve. Okay, now let's decode this a little bit. Demand deposits are exactly what they sound like. Demand deposits are just deposits at a bank that the person who deposited them can demand, right? So for example, if you have a checking account, right, you can walk into the bank and be like, hey, I'd like my money out of the bank. Okay, well, that's a demand deposit because you can demand it. Second thing, unreserved. Okay, well, when we say unreserved, what we mean is the bank either needs to have a portion of your deposits either in their vaults, that is, sitting sort of at the bank, right? Or they need to have those on an account with the Fed, with the central bank. So, for example, your bank and all other banks have an account with the Federal Reserve, just like you have an account with them, right? They've got an account with the Fed. Now, in this example here, and in all the examples I'm going to do in this class, I'm just going to make it 10%. The reality is that the required fraction, the required reserve fraction, varies by account type, right? So like very liquid accounts, like checking accounts, have a higher reserve, and very illiquid accounts have a lower reserve. That reserve is set by the Federal Reserve within a range set by the U.S. federal government. Okay, so as a consequence, what you're going to see on any bank balance sheet on their asset side is their reserves. That means, right, that the majority, right, assuming the fraction's less than 50%, right, but a majority of any deposits aren't at the bank, right? What the bank does is they try to lend those monies out or somehow engage your deposits in some kind of profitable activity, because again, that's their job. Okay, so let's say that the situation is like this. On a $100 deposit, they have to hold 10% or $10, right? And the remaining $90 can be lent out. Well, then the bank's balance sheet looks like what we see over here. Right. Now, the thing about this is that when that loan was made, of course, now, the reason why you get a loan is to spend it, right? Nobody gets a loan to save the value of the loan. Be silly. But the minute the loan was made, right, now there's $190 of purchasing power. Okay, so the $100 demand deposit, right? If I go in my bank and I demand the money out, right, they got to give it to me, right? But the person who got the $90 loan, right? Like if I go into the bank and I'm like, hey, give me my $100, they don't call the guy who got the loan and say, geez, sorry to tell you this, but you're gonna have to pay that loan back because the guy wants his $100. Right? No, it's not how it works, right? I mean, loans do get called in. Usually when you get a loan, right, there'll be a stipulation in the agreement that they can call it in early under certain conditions and require you to pay it back early. But it's generally not because some person came in and pulled money out of their checking account. No. So what's happened is that the bank has created purchasing power from nowhere. Based upon what, right? So again, this is the point where some people get shocked and be like, oh, we got to have gold, right? Gold standard. So banks, can't freak out, right? But why was that $90 loan issued? Well, it was issued presumably because somebody was going to do something good with it. Okay? And that's, again, the bank's job is to try to figure out who's going to do good things with that liquidity and then provide it to them. Okay. Where does it come from? Comes from nowhere, right? It comes from the loan officer's decision making. There, of course, is the reverse of this too, right? If every time a loan is created, it creates purchasing power out of nowhere, right? Then it implies that anytime a loan is repaid, it's destroying purchasing power, and indeed that's true, right? So, if when a person comes in and pays off that $90 loan here, then that purchasing power disappears, right? It reverts back to the initial $100 demand deposits, as we see in these two T accounts here. The one on the left representing the loan position, and then the one on the right representing the closed loan or a loan repaid position. Okay, so now one last thing to note about this that is significant and interesting is that unlike any other industry, the financial system or financial industry is uniquely interconnected. Okay, looking at this balance sheet or any of the other balance sheets we can see that the assets of one bank are the liabilities of other banks, and the liabilities of some banks are the assets of other banks, which means that damage to one bank's balance sheet is going to impact other banks' balance sheets. Okay, this idea is known as contagion, right? Well, it means that if a bank is holding as its assets the liabilities of some other bank, and that bank is no longer able to cover its liabilities, then of course it damages the asset side of the other bank. So if we have some banks that make a bunch of bad loans that it cannot receive, that is very likely going to damage the balance sheets of other banks yet that had nothing to do with those bad loans. Okay, and so this makes the financial system uniquely precarious in that calamities in certain aspects of the financial sector tend to spread. We've learned that the function of the financial system is to provide nominal resources to profitable real economic activity. That is to say, to provide whatever amount of liquidity is necessary to get good stuff done. That's the financial system's job. And it's also their job to make sure that we don't supply nominal resources to bad ideas. Both are equally important. We've also learned that the financial system is not constrained by nominal resources in the way that folks normally think. People say like, oh, there's no money for X, Y, Z or whatever. No, there's always nominal resources for good ideas. In this way, the real sector is never really constrained by available nominal resources. Okay, if you have a good idea, the money will be forthcoming. From that, we can certainly infer that money and credit is highly flexible, right? And indeed, in the United States, on a daily basis, billions and billions of dollars are created and destroyed. Okay, so this sort of idea that a lot of people carry around that, oh my gosh, if the Fed does this or that, somehow there's going to be this huge inflation and money's going to become worthless. And this is just a serious misunderstanding of how the financial system operates. The flexibility of money, the quantity of money and credit is in fact what makes prices stable. If the quantity of money were stable, prices would not be stable. All right, so now that we have an understanding of the basics of a fractional reserve system, and we understand sort of the basics of a bank balance sheet and the sort of leveraged nature of the U.S. financial system, let's turn our attention to the central bank. The central bank is the sort of force that stabilizes this somewhat fundamentally unstable structure. One of the main functions of the Fed is to issue coin and currency. And just as we saw in the last video, despite conspiracy theories to the contrary, the U.S. dollar is not super mysterious. And in fact, pretty much everything that you would need to know about it is written on it. The Fed is essentially a banker's bank. So it is the sort of master bank, if you will, that stabilizes all other banks. All banks have accounts at the Fed these days. Well, I shouldn't say all banks. Any reputable bank will have an account at the Fed. The Fed performs a number of functions, including clearing activities between different banks, providing liquidity to banks, which is what we'll talk about in great depth in this video, as well as maintaining banking reserves in general. Okay, so the federal government also has an account as the Fed, as was implied in the last video. So the federal government, so the U.S. government in this case, where do they bank? They bank at the Federal Reserve, or the central bank of the United States. When the federal government spends, it spends money from its account at the Fed. The Federal Reserve is often said to have a dual mandate. And that dual mandate refers to their dual role in providing stable prices and full employment. Right? So their job is supposed to be to provide sufficient liquidity to fund all profitable activities. Right? So just as we saw in the last presentation, the U.S. monetary system and virtually every other fiat monetary system in the world is flexible, and it flexes to do what? To fund functional activity while constraining non-functional activity. So the Fed's job is to provide the right amount of liquidity to ensure that all good ideas get done, but that bad ideas don't get done, and that this ends up producing full employment of all resources, including labor, of course, but also price stability. Now, the indicators of that going wrong are that if we have significant unemployment, then we have ideas that probably should be getting funded that aren't getting funded, or we have insufficient liquidity in the financial system. And if we are experiencing significant changes in prices without significant changes in output, in other words, the prices of existing things are going up, but new things aren't getting created, then we probably have too much liquidity in the financial system. We're probably starting to fund sort of bad ideas, if you will. So the Fed's job is to make sure that we sort of get that right. Now, to do this, the Fed has a number of tools to conduct what we call monetary policy. And so monetary policy is central bank actions, in this case Fed actions, designed to alter the money supply and the price of liquidity in such a way to get it right, to maintain full employment while maintaining price stability. The traditional tools that they have to do this are three, and we see them here on the left-hand side. That is the reserve requirement, which we've learned something about already, as well as the discount rate, which we'll learn more about here, and open market operations. Now, of these three, the most commonly used is our open market operations. Now, in the recent financial crisis of a decade ago, the Fed started developing some unconventional tools. The first of these was and is referred to as forward guidance. This continues to this day. And the second is quantitative easing / tightening, which was used during the financial crisis and for many years thereafter. Then it ceased for a number of years. And now we're back in a situation of quantitative easing. The reserve requirements are the portion of bank deposits that banks have to retain. So, and we already learned that every time a bank makes a loan, it effectively is creating credit. When loans are repaid, they're destroying credit. Okay, so implied in this, is that the reserve requirement is somehow limiting banks' ability to provide credit, and indeed there is something to that, So, for example, if we raise the reserve requirement, then we're reducing the portion of any given deposits that can be lent out. Whereas if we're lowering the reserve requirement, we're doing the opposite. A greater portion of demand deposits can be lent out, thus creating additional credit. Okay, so if the central bank wished to significantly reduce credit availability in the economy, one way in which they could do so would be to raise reserve requirements. As a practical matter, the Fed doesn't do this very often because this would be quite a dramatic thing to do. I mean, you can imagine if every bank was lending to its capacity and the Fed raised reserve requirements, then every bank across the country would suddenly be short of reserves, which would create quite a crisis for reserves in a short period of time. Okay, here we have the sort of second tool of the Fed, and that's the discount rate and the discount window idea. Now it starts to get a little confusing here, but I think if you bear with me, you can understand this. Okay, now we learned in the last video that if everybody comes in and demands their money out of the bank at the same time, the bank's not going to have that money. So that's a problem, right? Okay, well, one of the jobs of the Fed is to provide that liquidity in the event of that happening. So let's say everybody runs into the bank and says, I want my money out right now. Well, the bank manager is going to get a call on, first of all, they're going to try to borrow from other banks, but we'll talk about that in a few minutes. But let's say they can't borrow from other banks, and so they put in a call to the Fed and they say, hey, we need some cash over here right now. Well, the Fed's going to do that, right? The Fed's going to provide that liquidity, and they're going to provide it through something called the discount window. Okay, sounds a little silly, but that's what it's called. So the discount window refers to the ability of banks to borrow reserves from the Fed in the event of them needing to do so. Now, that is a service of the Fed, and so the Fed charges for that service, and they refer to that as the discount rate. You can find the discount rate or the primary credit rate, as it's referred to there, of course, at the Fed, or you can search it at the Fed site, or you can find out what that is in whatever time period you're watching this. So, of course, by raising the discount rate, what is the Federal Reserve doing? It's saying, well, yeah, you can make a bunch of loans and run short on reserves, but it's going to cost you more to borrow from us. So raising the discount rate is a signal from the central bank to the banking system to be somewhat more careful about providing credit. And conversely, lowering the discount rate is a signal to the financial system, hey, go ahead. You can be a little looser with credit. So it's a softer signal when compared to reserve requirements. Okay, one last thing about the discount window and the discount rate. This is also not a very commonly used policy by the central bank. The central bank would prefer banks to be borrowing from other banks rather than to be borrowing from the Fed. This is really used in emergency situations. So for example, I can remember well, on the morning of September 12th, 2001, then Chairman Alan Greenspan coming on the television and talking about how the discount window was available to provide whatever level of liquidity necessary to stabilize the U.S. financial system. In other words, on September 12th, 2001, we just had this terrible attack in New York City. And, there was a lot of concern that maybe people thought maybe that the economy would collapse. And so if everybody ran into the bank and tried to get their money out, right, it wasn't going to be there. And so the Fed came across the television. Internet was kind of young still in 2001. So they came across all the main television stations saying, if banks need to borrow reserves, hey, we're good to go. We're all set to get that liquidity out there. So, no need to worry, no need to run to your bank to get your money out quick because, we're going to hook it up. More recently, during the financial crisis, the discount window was used again, and in recent years, right? So now we're hopefully towards the tail end of this pandemic. At the early stages of the pandemic, the discount window was utilized as well. Okay. The final tool of the Fed is the one that's used most commonly, and it's done every day, right? So today is a holiday, so it probably wasn't done today, but on any normal weekday, the Fed is conducting what are called open market operations. The Fed adjusts the level of liquidity in the financial system on a daily basis using these open market operations, and what these refer to as the purchase or sales of, in normal times, of Treasury debt, right? So how this works is the Fed will, if it wishes to reduce the amount of liquidity in the financial system, what they can do is they can sell Treasury debt. Remember in the last video we learned how the Fed sits on Treasury debt and how that fits into the value of fiat money and also because the Fed can sell some of that out to the financial system. Now if the Fed sells Treasury debt out to the financial system, of course, let's say your bank buys some Treasury debt and they used to be sitting on US dollars. Well, they could have lent you those US dollars, but they're not going to lend you Treasury debt because you have no interest in borrowing it, right? When I go to the bank and I ask for a loan, right, I'm not asking for them to send me some Treasury debt. I'm asking for US dollars. Okay, so when the Fed sells Treasury debt to the financial system, what it's doing is it's constraining bank lending. And if the Fed chooses to buy up Treasury debt from the financial system, what it's doing is it's expanding the capacity for bank lending and therefore expanding the capacity for credit creation. So in this way, the Fed can, on a daily basis, through the purchase or sale of Treasury debts, adjust the amount of liquidity in the financial system to meet current needs, right? Remember, the whole point of this is to fund productive activity, right? And to not fund unproductive activity, right? So right now, the way this works can be seen on the balance sheets below. So before it was an expansionary open market operation, this is a contractionary open market operations. I have a separate video on just this, right? So on how we conduct open market operations. So you might want to take a look at that. If, in this way, the Fed is able to either, to the tune of many, many billions of dollars on a daily basis to expand the money supply if needed, and similarly to contract it, right? So if the Fed anticipates inflationary pressure in the economy, they can very quickly mop up this excess liquidity. And that's how they'll say it too. They'll say mop up, right? So we're mopping up excess liquidity. Well, what they're doing is they're just pulling liquidity out of the financial system. You may say, well, why would banks want to buy Treasury debt? Well, because it earns interest, right? So let's say if you're a bank and you're sitting on a bunch of extra cash, nobody wants to borrow it, and somebody comes in the door with a bad idea, and you're like, geez, maybe I should lend it to them, so at least I'll earn some interest. Well, that's exactly what the Fed doesn't want. So they're going to try to scoop up that liquidity and then give the financial system treasury debt, which earns interest, right? Not a lot of interest, but it's more than zero. Okay. Conversely, if the banking system appears to be in a position where they want to make a lot more loans than they're currently able to, right? So the price of loans is going up higher than the Fed would like it to be. And the Fed can just provide more liquidity to bring those rates back down. And of course, banks are going to want it because they can earn more on those loans than they can earn on the treasury debts that perhaps they're sitting on, right? So in both directions, there's an incentive for banks to change their balance sheet position from holding loans to holding treasury debt or vice versa. The last thing we should talk about with open market operations is sort of how does the Fed know, right? Like, how do they know whether there's not enough money in the system or too much or too little or what? The answer is they're looking at something called the federal funds rate, which they target, right? So you'll hear like the Fed funds target. Okay, well, what the heck's the federal funds rate? Federal funds rate is the rate at which banks are going to lend reserves to each other. Right, so remember before when we said they could borrow at the disco window, right? We also said the Fed would like them to borrow from each other, right? Okay, so the rate at which they can borrow those reserves from each other is called the federal funds rate. It's set by the market, right? So supply and demand. But the Federal Reserve will target it, right? So let's say that the federal funds rate is getting too expensive, like it's getting more expensive than the Fed would like it to be. Well, what they're going to do then is they're going to dump liquidity. That's going to be the signal to the Fed, like, oh shoot, we need more liquidity in this financial system because loans are getting too hard to get, getting too expensive. And if the reverse is true, if the federal funds rate is getting very low, right, then the Fed's going to look at it and say, oh, there's too much money in the financial system, we're going to scoop it up. Okay, and they're going to run contractionary open market operations. All right, in the graph below, we see the blue line is the discount rate, the discount rate, and the red line is the federal funds rate. Now you'll notice that the two track together, and that's because that's by design. You'll notice the blue line is always slightly higher than the red line. That's by design because the Fed would prefer banks to borrow from each other than from the Fed, right? So borrowing from the Fed is always a little more expensive than borrowing at the federal funds market. Okay, quick word about unconventional tools. Forward guidance. It's going to seem strange to people watching this in 2020, but years ago, thinking of the central bank was for them to be kind of mysterious, right? Which is a lot of where the sort of rumors and odd stuff you hear about the central bank come from. And the thinking was, this is particularly true during the Greenspan era in the 1980s and early 1990s. The thinking at the time was that if the Fed was too clear about anything, then it just wouldn't work, right? Like the Fed wouldn't be able to get anything done. This is not the case anymore. So current central bank thinking, and really thinking for the last 10 years, at least 15 years, is more that the Fed should provide clear guidance about what it's doing, why it's doing it, and how long it expects to do it for. This was originally developed, during the Great Recession years, and it's come to be known as forward guidance. In 2020, when I'm making this video, it's almost standard operating procedure at this point. The other unconventional tool of the Fed is known as what's quantitative easing. Okay, what quantitative easing was and is, rather than just buying up treasury debt from the financial system, the Fed started buying up all kinds of debt from the financial system. So if you can imagine an open market operation where normally the Fed would be saying like, oh, it looks like you got a bunch of treasuries on the books, we can provide you with cash which you can lend out, right? And in this way bring rates down and stuff. Now the Fed is going, oh, you've got a bunch of assets on your books here that are illiquid. We'll just buy those from you at an agreed upon price and provide you with cash. Okay, quickly on this slide here, this was the Fed's balance sheets, total assets. So you can see that in 2009, there was the beginnings of a huge explosion in assets. So this is the Fed buying up all kinds of assets from the financial system and providing liquidity. You'll notice that starting in 2015, that that starts going down slightly, and then starting in 2018, it starts declining rapidly. So during this period from 2015 through the beginning of 2020, the Fed was generally removing liquidity from the financial system. Prior to 2015, the Fed was dumping liquidity into the financial system. And since the beginning of the year, since January 2020, the Fed has again been dumping liquidity into the financial system. So if we were to see that graph for 2020, it'd be shooting back up and actually quite quickly. Okay, over here we see the Fed's balance sheet from February 2019. These are published fairly regularly, so there should be a couple newer ones than that one you see there. You can find this at the Fed's website. Just go to the Fed's website and Google balance sheet or search balance sheet. You'll get something like this. You'll see selected assets, selected liabilities, right? And those look a lot like the little balance sheet that we made in our video. So therefore, sort of confirming the story I was telling you before. You see right at the top of there, assets is U.S. Treasury securities. Okay. It also tells you the change in position, right? So these are all negative. So you can see that in February 2019, the Federal Reserve was selling off treasuries. In other words, they were contracting the money supply. On the liability side, the first one you see there were Federal Reserve notes in circulation. Okay, all right, so that's your U.S. dollars, right? Okay, so you might just check this out and see what the Fed's doing right now. Again, not super secret. It's all pretty much right there if you just know how to use the search engine. Okay, well, I hope you've all found this video informative. I think that banking and the financial system and central banking is perhaps the most misunderstood aspect of how the macroeconomy operates. Well, let's just leave it there. Have a good day, everybody. See you next time. Bye.